Ever wish you could spot a stock ready to pop before it takes off? PEP Pepsi is flashing a textbook double bottom, a classic bullish reversal pattern that could send it higher. But we are not just buying this particular stock, we are structuring a high probability option play with a limited risk and an explosive upside. Want to see how to maximize gains while keeping the risk tight? Stay tuned. This trade setup could be a game changer. Okay, good morning, everyone. Welcome back to the Sensa Edge. This is your host, Sohaib, where we dissect all things in the market and how best to trade them. Today, we are going to talk technicals rather than fundamentals for a change. We are going to look at a double bottom pattern forming PEP Pepsi, always lurking in Coca Cola's shadow, but somehow still manages to own everything in your snack cabinet. Let's start. What is a double bottom pattern? It's kind of a classic bullish reversal signal. Imagine a stock price dropping, finding support at a key level, bouncing up, failing, and coming down to the same support level and bouncing again. That's a double bottom, like the price at an invisible trampoline twice. I'm going to bring up the screen here and then let's jump in here. So if you can see here in this particular case on Pepsi, you see the double bottom position. Traders look for this because it signals that sellers are exhausted and buyers are ready to take over. And if the pattern plays out, the stock should move higher. On PEP's daily chart, which is around $149 currently, um, the support sits right around 142, if you can see here, and the next level up is $155. If that breaks, that could trigger all the way to 160 or 165. We aren't going to hold that long though. um, Bringing myself back here, PEP is not a meme stock. It's not the latest AI darling, and it certainly isn't going parabolic anytime soon. It's a slow moving, dividend paying consumer staple, but that's one of the reasons why the setup is interesting. Low implied volatility makes it cheap to put a certain option structure. Again, to be clear, we are not buying this particular stock. PEP isn't exactly a thrill ride, and there is no need to tie up capital when we can structure something better in the strategy. Instead, we are going to use the strategy advantage of the potential move while keeping the risk low and the time decay from eating our face. So let me bring into the strategy builder screen and then let's jump in there. So if you can go to the option strategy screen in the sensor market, I've already selected option strategies, and this particular screen on the builder here, you can call ratio back spread. Again, as I said, Pepsi trading around $149 stock price. What you're going to do here is you are buying two particular strike price. You are selling $140 call for expiration of somewhere around May, and you're buying twice $150 call. This creates a low, again, a ratio spread where we are selling a lower strike call and buying twice as many higher strike call. The beauty, we collect a small credit upfront while still having the upside exposure if the PEP moves higher. Why, you might ask, why this particular trade? Cheap structure, because we are selling a deeper in the money call. The premium offsets the cost of buying the two OTM calls. It's a defined risk with a potential explosion in profit. If PEP grinds up towards $160, this trade could work well. If it stays stagnant right around this particular place, we could lose. I can change the expiration dates according to when you'd be able to see that. I'm going to keep it at the full expiration date of May 116. You can see that this is the dip here, and anything upside is where the profit comes in. Again, low volatility environment, when implied volatility is low, the long calls are relatively inexpensive, making the structure attractive. The entire structure is also long volatility, so if there is a sell-off and the volatility goes up, the exposure to the IV will be absorbed loosely. You can also tap on the strike price and see the implied volatility, which is around 20 here and somewhere around 19 implied volatility. The maximum profit, technically the trade has no max profit, but we will exit if it hits $155 or so and yield in a good $140 to $70 profit depending on the exit time. You can adjust all the expiration date here to see when you could probably exit. Again, the break even here could fluctuate quite a bit. It doesn't make sense to list it here, but you can see on the platform here to analyze and find the break even points at a given day at any time in the future by selecting or changing this particular parameter in the screen. When implied volatility is low, making long options cheaper when you believe a stock will explode in either direction, but probably up, this is a good particular strategy. For this trade, I'll set a hard stop if the PEP drops below $140, which is a pattern failure, or somewhere around shoot for March 19. Whichever comes first, I'll close this trade of PEP at 155 when it is $155. Again, note while the spreads are good for PEP, they aren't great. It's not as liquid as the markets say on Coca-Cola. Sorry, I had to say that. So you'll be giving up on a bit of slippage, but that's part of this particular game. The OTM call back spread is an underappreciated strategy that is great for hard, fast, huge move. Again, if that doesn't materialize quickly, though, take the trade off from this particular position. Again, next time on the Sensa Edge, we'll dive into the zero DT strategies for a bit. And be sure to subscribe, leave a review, and follow us on the platform. Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.